Hello, I am Sonia from Zeygos, and today I will share with you an analysis of the financial markets prepared by our research department. If you find value in our content, I invite you to subscribe to our channel. Pre-opening commentary. Tesla, a challenging quarter analysis. This morning's commentary is dedicated to the analysis of Tesla's quarterly report. Those who have been following us for a while know that during the reporting season, we take the time to comment on the quarterly results of companies with significant impact on the markets, and undoubtedly, Tesla is one of those stocks that cannot be overlooked. The results of Tesla have been disappointing. I reiterate, they are disappointing. We extend our compliments to Elon Musk, who once again demonstrated his exceptional acumen by presenting better numbers than the actual underlying performance. However, the reality differs significantly from appearances. Let's examine the numbers. Tesla achieved a revenue of $24.9 billion in the second quarter of the year, surpassing analysts' expectations of $24.5 billion. Earnings per share stood at 91 cents, notably higher than the market consensus of 81 cents. Upon reviewing these figures, one cannot deny Elon Musk's achievement. He managed to generate increased profits and higher revenue than expected, despite, or thanks to, the pricing reduction strategy implemented in recent months. But as the English say, the devil is in the detail, and we uncover it. The situation of Tesla is far from this rosy and optimistic picture. It is characterized by shrinking margins, increasing inventory, declining cash flow, all within an increasingly competitive market. The reported profits are real, but they stem from mere accounting adjustments, primarily attributed to the increase in the other income line item found below the operating profit line, which entirely explains the difference between the actual profit and the market's expected profit. Some might maliciously call these figures manipulated. We, however, simply highlight the source of this improved outcome. Tesla has now become a company whose margins continue to contract, whether it be in the automotive division or overall. Year over year, the automotive division's margins have declined from 25% to 18.5%. Although they are still significantly higher than those of the automotive sector, a comprehensive analysis of Tesla reveals that its overall profitability, currently at 10%, is, on average, aligned with that of its automotive sector competitors. It is now lower than Mercedes' profitability and on par with Hyundai's. So, why should investors continue to pay such high multiples for an automotive company, as this is the market it competes in, despite being often presented as a tech company? How can market multiples that are 10 to 20 times higher than those of competing companies be justified? Tesla currently trades at 62 times estimated earnings for the end of 2024 and at 84 times estimated earnings for the end of the current year. In contrast, Stellantis trades at just 3 times earnings. 3 times. And Elon Musk's fans respond to this question without any problem. It's the potential for growth that makes the difference. However, looking at the numbers, Elon Musk is already struggling. It's the 5th consecutive quarter in which the company produces more than it sells. The result is an increase in inventories, a rise in days of inventory, tripled, and a contraction in cash flow. In the current quarter, the company's generated cash flow was only $1 billion, half of what analysts had expected. The truth is that Tesla is coming face to face with reality. It's starting to align itself with the industry it belongs to, the automotive industry. Those who have been in the automotive business for a long time know that the industry is highly competitive. If you want to increase market share, you must be competitive on pricing, even at the expense of margins. What is happening to Tesla is a progressive shift from an elite company to a mass-market automaker. And to become one, it must align its margins with those of its competitors. Period. I conclude by asking this question: does it make sense that a company whose profitability dropped from 25% to 18.5% in a year justifies a $530 billion increase in its market capitalization since the beginning of the year? Why should market multiples of 62 to 80 times earnings be justified for an automobile company? Even if it were a tech company, with a pure tech stock, these multiples would still be questionable. But Tesla's supporters remain steadfast, claiming that Tesla is a tech stock exposed to AI. While it will undoubtedly benefit from AI, consider Nvidia, which is, without a doubt, the tech stock most exposed to the AI theme. Yet, Nvidia trades at 50 times earnings, and it's considered expensive.